I'm Wes-tone, Grammy-recognized songwriter, music producer, trader, entrepreneur, and educator. And in this video, we're going to discuss the premise of the wealth cycle strategy. Nikola Tesla said that if we want to understand the universe, that we need to think in terms of energy, frequency, and vibration. And as a music producer, I've learned a lot about that over the years. Einstein said that E equals mc squared, which means that energy equals mass. We tend to think of things as having energy, but mass not only has energy, it is energy itself. Therefore, everything is energy, and energy implies vibration. Vibration implies frequency. And that means everything has cycles. Light itself has cycles. Sound has cycles. Our bodies are in harmony with the Earth's cycles, rising in the morning and sleeping at night. Seasons are caused by the Earth's cyclical rotation around the sun. As I walk down the street, my arms swing in a pendulum, oscillating cyclical fashion. I could go on indefinitely because literally everything is energy and has energy, and therefore has cycles. This sine wave is the most basic visual representation of a cycle. Think of it as a visual representation of something oscillating or vibrating back and forth. This image shows the various characteristics of a sine wave. Amplitude represents the amount of energy or the signal strength. Higher amplitude means more energy. With light, greater amplitude means a brighter light. With sound, greater amplitude means louder. We also have the wavelength, which is the same as one cycle, measured from crest to crest, or trough to trough, or 0 point to 0 point, in this case A to E. Frequency is how many cycles per unit of time, or how quickly or slowly something is vibrating. These various sine waves all have the same amplitude, but different wavelengths. Color is how we perceive different wavelengths of light, as seen by the image. Red is a low-frequency oscillation with a longer wavelength. Blue is a higher frequency cycle with a shorter wavelength. Pitch is how we perceive different wavelengths of sound. High pitch is a higher frequency vibration with a shorter wavelength. A low pitch has a lower frequency oscillation with a longer wavelength. This is all very simple and well understood in current science, but the challenge is to apply this simple logic of energy, frequency, and vibration to all areas of human study and identify the infinite number of cycles that exist around us and how they interact with each other. Wes-tone's wealth cycles will attempt to try to apply this to financial markets and asset valuations. So how does this apply to investing? Why don't price charts look like a sine wave? These are some long-term charts of various assets. None of them exhibit any sort of cyclical-looking behavior. But what they do have in common is that they all appear to go up and to the right with a fair amount of consistency. The key to that lies in the fact that we are using US dollars to measure their values. This is number of US dollars per barrel of oil. US dollars per one share of the Dow Jones. US dollars per ounce of gold. Given that we don't really see any cycles, what can we glean from this information? Well, what's really happening here is that the value of the dollar is declining over the long term relative to these various assets. So I obviously just flipped these charts upside down to show you the purchasing power of the dollar over time. It's declining. Inflation is real and it is nasty. So what that ultimately means for us is that fiat money is a bad measuring stick. Fiat money just simply means that it's the money that government forces you to use. And it's issued by government for government as government debt. This includes US dollars, euros, Japanese yen, the currencies we're all familiar with. Fiat money is not redeemable for, quote, something real such as gold or oil. Gold and oil require a tremendous amount of energy to acquire. Unlike fiat money, which is essentially created at the whims of central planners in the government. Fiat money amounts to entries on a ledger or printed pieces of paper at this point. And so gold and oil have intrinsic value because not only are they useful and in demand, but they require a tremendous amount of energy to acquire. And because fiat money costs essentially nothing to create, it'll trend toward its intrinsic value of zero over time. A US dollar bill is not intrinsically more valuable than a post-it note. Fiat money is backed by force and debt. Fiat money, think of it as a measuring stick for prices. If I measure myself every year with a ruler that shrinks by half every year, the first year I will measure 70 inches, the second year I'll measure 140 inches, the third year 280 inches. I've stayed exactly the same height, but my ruler has shrunk. Here's what my height would look like on a chart. A line going straight up and to the right, kind of like our price charts that we saw earlier. Now, this example assumes a predictable rate of shrinkage. In reality, the shrinkage of fiat money or the supply of dollars are less predictable. You can also think of prices as a ratio. In this case, a ratio of number of dollars to ounces of gold. It's much easier to print pieces of paper than it is to mine ounces of gold, so the ratio increases over time. Prior to the 1930s, gold was fixed to dollars at about $20 an ounce. Today we're nearly $3,000 an ounce, and that's a lot of new dollars floating around the economy. So let's stop using dollars as a measuring stick and compare things to other things. And we can just simply do this by dividing the price of one by the other. Over the last 75 years, we've seen a steady ratio of between 8 and 30 barrels of oil per ounce of gold. Since both oil and gold require great effort to acquire, their supply is constrained, and the relative values are fairly stable over time. And we can do the same thing with any and all other major assets by dividing them against each other to eliminate the dollar from the equation. And when we start to divide these assets against each other in every conceivable combination, we can start to rank them in order from overvalued to undervalued with a high degree of clarity. We can take oranges and divide them by median income. We can take oil and divide it by cattle. We can get the Dow Jones and divide it by silver. Copper divided by the median home price. In practice, this is what that looks like. Here's the Dow Jones long-term chart divided by gold. What we get here is starting to look like a cycle. It's starting to look like a sine wave. Doing this makes it easier to identify when one asset is over or undervalued relative to the other. When we're at the top of the channel, stocks are high, gold is low. When we're at the bottom of the channel, stocks are low. In reality, though, prices don't always go down as measured in dollars because they're constantly printing more money. From the 60s to the 80s, both stocks and gold went up as measured in dollars, but gold went up much more than stocks. So you might have thought that you didn't lose any money holding stocks during that time, but you actually did, because you could have made a lot more in gold. If you held gold, you could have then traded that gold for a lot more shares of the Dow in 1980. After 1980, stocks went up tremendously into the year 2000, while gold actually went sideways or down as measured in dollars. So the question really is, which assets are going to go up the most? Because it looks like they're all always going up all the time if we use dollars to measure their value. So when gold is in a bear market, the price in dollars might still be going up. Over the long term, though, they both increase at the rough rate of fiat currency creation. If we can be in the right market at the right time, we can skip most of the downside in the market, and our net worth should do something like this. Shawing. And as I said, we can do this in every combination and then begin to rank these assets from overvalued to undervalued. This gives us a very clear 10,000 foot macro view of asset values. Now, these cycles aren't the only thing to consider, and they're not perfect sine waves. And of course, outliers and black swan events always exist. I'm a simpleton. I'm no genius. I believe that if you can't explain something simply, then you don't really understand it. And even though something might be simple to understand, that doesn't necessarily always make it easy to execute. I'm Wes-tone. Join me on this YouTube channel as we look at investing through the eye of the wealth cycles strategy. If you like this content, like it, subscribe, tell your friends, engage in the comments down below, because we all learn a lot when the smartest amongst us contribute. All right, we'll see you in the next video.